The price of a stock literally does not matter. Now, this is not clickbait. Wait until you hear what I actually have to say. But at its most literal level, a company can make its stock price whatever it wants it to be. And so do not focus so much on the actual price of the stock. You should never, ever compare stock prices to each other, which is very common for sort of early investors. I know I did that when I first started investing in middle school. And so you should never do that. But let me explain why. A company can have as many shares outstanding as it wants. So a company, when you're looking in the financials, it's usually going to be at the bottom of the income statement. You'll see basic shares outstanding. Now, I don't want to get too technical, but I do want to give you a little bit of an understanding of what's happening with these share counts. And so there's a basic share count, which is the shares that are currently outstanding. There's a diluted share count, which is very often because let's say you're an employee at a tech company and you get stock options. Once they become what's called in the money, which means that they're kind of worth something, then the company is going to eventually potentially have to issue them stock if they decide to issue that. And so all of those stock options, and also if the company has something called convertible debt, which could be debt that can convert into stocks. And there's a bunch of other instruments. It doesn't really matter. Basically, there's other sort of claims on the business that could be turned into shares. And all of that is included in this diluted shares outstanding amount. So you have basic, which is currently outstanding, and you have diluted shares, which includes all of this sort of other stuff. There's one other complexity, which is that then there's a third one called weighted shares outstanding. And so weighted means that basically if a company issued, for simple math, if a company had 100 shares at the beginning of the year and then issued 100 more in the middle of the year, so they had a total of 200, for half the year they had 100, for the other half of the year they had 200, the weighted, which is kind of like the average, would be 150. And so that is what that number is. Personally, I would just look at that diluted shares outstanding amount and kind of just ignore the rest if you're just getting started. Yes, eventually you want to be aware of all sorts of caveats, but generally speaking, it's good enough to just look at the diluted amount. You kind of want to just look at the biggest number possible for conservatism. And so that number is basically how many shares are outstanding. A company can decide to not only issue more shares, but they could also split their shares. And so what that means is if you have one share, they could say, now we're going to give you 10. Why they do this is really just because they want to change the stock price potentially. If the stock price got very high numerically, it used to be very hard for an investor to buy a share. So it used to be the case that you could only buy stocks in lots of 100. And so if you couldn't buy 100 shares, then you couldn't buy stock. And so yes, things got more digitized and technical, and you could easily buy one share of any stock. But even now, if a share of a stock is $1,000, they may say, well, let's bring that a lot lower so a lot more people can buy a share for maybe just $50. And so if it was $1,000 stock, that would be a 20-to-1 stock split that they would do. And so they're able to do this whenever they want. They could split their stock, and then they could do the opposite, which is called a reverse stock split, which is basically you have 100 shares. Now we're going to give you 10, and this is going to make our stock price higher. Now, companies will tend to only do this when their stock price gets very low and they're at risk of being delisted. Most exchanges have sort of rules that if a stock price gets below $5, it is at risk of being delisted. And if it gets delisted, then you can't trade it easily. And so in that case, they'll do a reverse split. And so that's another instance of a company changing their stock price. And so you have these shares outstanding and you have the stock price. And so just to give you a quick framework for this, I want you to first think of something that is called the market capitalization. The market capitalization is basically the value of the business that the stock market currently assigns. And so whenever you hear a company is worth $100 billion or, NVIDIA is now a $4 trillion company, what they're talking about is that market capitalization. The market cap, as it's called for short. And so that is what the stock market currently values the entire business as. Now, all you have to do is take that number and divide by shares outstanding, and you'll get the stock price. And so that's why they're able to change the stock price, because they could change the shares outstanding to shrink it, to expand it. And that will directly change what the stock price is. Now, how much does this matter? How many shares you own of a stock versus not? It doesn't really. What the stock price is of a company doesn't really matter. For a silly example, let's say that you have a cake at home and you're going to split the cake and you were promised you would get 25% of the cake. No matter what, you'll get 25% of the cake. And the person cutting the cake's going, do I cut it in 20 slices, 40 slices, 50 slices? You kind of would be like, I don't care how many slices you cut it in. I know that's a little impractical, but I don't care how many slices you cut it in because I'm getting 25% of it no matter what. So if my 25% is 20 really small slices or one really big slice, it doesn't really matter. It's still, I'm getting 25%. So that's why it doesn't actually matter when companies are splitting their stocks or doing reverse stock splits, because in the end, you still own the same amount of the business. Yes, it does change the stock price though. And so that is why I said the literal stock price does not matter, because they could make it higher if they wanted to by doing a reverse stock split, or they can make it lower by doing a regular stock split. And so if you do want to compare like the value of one business to another, do not use the stock price, use the market cap. So that will compare the valuation of one business versus the other. The stock price does not do that. Many people know this. This is just a kind of a pet peeve of mine. I saw some comments in the videos, and so I just wanted to clarify that. The literal price of a stock does not matter. Again, one business may split that cake they have 100 times. The other one may split it 50. One may split it only twice. Okay, if you're only looking at the stock price, you're not looking at how many times they split it, which is how many shares are outstanding. I hope that's a simple one, but if you have any questions, go ahead and drop them in the comments below. And if you want to see any other topics covered, feel free to drop any questions. And if you're enjoying these videos and want to continue to learn more about investing in business, go ahead and hit like and subscribe.